Hi, my name is Kim Brown, and I'm with First Shield Financial. Thank you for your interest in mortgage note investing. Before we get started, I just want to give you a little insight to myself. Like you, I have been in real estate investment, I guess maybe for the last, I don't know, 3, 4, 5 years. I started out as a wholesaler and then went into fix and flip and then went into fix and hold. I'm a landlord today. But through my journey of real estate investing, I stumbled into mortgage notes. I didn't know anything about mortgage notes. I didn't even know it was an option to as a means to do real estate investment. And so I started out taking a couple of modules online. That wasn't working out too well. So then I signed up with a mentor, which made all the difference in the world as far as understanding and embracing and having someone to talk to. I was intrigued, and it just seemed like this was the right thing for me to get into. I then transitioned from that program, the mentorship program, into JVing with my mentor, and that changed everything. I loved the note investment as far as real estate investment, and this is what I completely focus on. It's been a little over a year and a half. I started out with a 1, maybe 2 note investing. Today I'm up to 49 notes. I love it. It's intriguing. There's strategy. There's opportunity to grow your wealth, diversify your portfolio, and see the different perspective of real estate investment from a banker perspective as opposed to someone who is paying the bank. Anyway, we'll walk through the fundamentals of it all, see if this might be something you might be interested in, and in the end, my contact information will be provided so that if you want to follow up and have some more discussions after this, we can do so. All right, let's get started. As an overview, we will discuss the opportunity, who we are, the mortgage note, have mortgage note insights, the investor advantage, what we do for you, and leveraging investing vehicle options, these tax accounts that you may already be invested in that you can use to leverage to invest in mortgage notes. So what is the opportunity? Mortgage note investing is a better place to put your money. The money is constantly working for you. You are the bank when it comes to mortgage notes. You are investing in the paper and not in the real estate, which means that your returns are based on the interest and the payments that have been defined by the promissory note. It's an opportunity to diversify your portfolio and gain higher monthly average yield on your investment as it compares to traditional investments. This is a low-risk investment with the ability to implement risk mitigation strategies on the onset of your investment, and all investments are collateralized to secure the investment, and we'll talk more about that. Who are we? First Shield Financial has a leadership team that is experienced with Fortune 500 companies and government contracting experience. The expertise is in finance, management, operations, compliance, and security. The leadership team, they are all vested and committed to the company full-time, holding mortgage note certifications with direct experience with real estate investment properties, including residential and commercial entities. With the commitment to grow wealth through mortgage note investing, leadership alone has invested well over 6 figures to build the foundation of the company to scale to larger realms of funding. Together, the leadership team has more than 40 years of real estate investment, private money lending, and mortgage note experience, which allows us to effectively work with investors seeking above-market returns on investments. With the company established relations, we buy mortgages from hedge funds, U.S. banks, and other reputable institutions. So let's talk about what is a mortgage note. A mortgage note is the promissory note. It is the contract with the terms of repayment that defines the scheduling, the interest rate, the duration of the note, and the monthly amount. It is the evidence of debt of the loan. It is the legal obligation to repay, and it is secured by the deed or the security of the mortgage, depending on which state it's from, and it's transferable, meaning it can be bought and sold. So what is the current state of mortgage loans? Mortgage loans right now are a little bit in a state of flux. And the reason being is that we've had a couple of dynamics that have gone on lately with mortgage loans. Interest rates over the last couple of years have gone from a low to a high, and now they're dropping again. There are mortgage loans out there with 2%, 3% mortgage rates. Today's, not too long ago, was 7, 8%, and then we have today where they're dropping. And there's predictions that they will drop 6 points between now and through the year of 2024. But what that does to traditional institutions, it puts their mortgage note platform in a state of flux because they have higher regulations and set guidelines that they have to follow. It's difficult for mortgage institutions to be flexible with the dynamics of mortgage rates. And so what happens is that when they have notes that they don't want on their books, they push them out into the secondary market. And that's where we are in the secondary market when we are investing in mortgage notes. And what that means, for example, we have mortgage notes out there with our 2%. And if you were a bank, would you rather have mortgage notes that you're holding that have 8%, or do you want the mortgage rates to be 2%? Well, they can't hold with so many notes, and so in order to get more of the 8%, right, they have to get rid of the 2%. So we have a lot of 2% mortgage notes out in the market. Another situation that took place not too long ago was COVID. You know, we had the mortgage moratorium and that was lifted. So now people are playing catch up. There are loan modifications. People have been laid off because of the economy. And then there's inflation. And then there's the uncertainty of the economy. We don't know if we're coming or going. And then, of course, we don't know with the new administration, if there's a new administration, you know. So all these things play a factor in regards to the borrower being able to maintain the status of their mortgage. And it depends on what the status of the mortgage and where the state of things are, whether or not banks and traditional mortgage companies will keep that mortgage or sell them. With that, mortgage notes are categorized. They are categorized either by performing or non-performing. Performing means that the notes are being paid in accordance to the promissory note without being late, etc. The non-performing notes are in default, or they're slow paying, or they're in the process of being foreclosed. Nevertheless, given the circumstances of what we discussed on the last slide and non-performing notes, First Shield can take advantage of buying these notes that are pushed out into the secondary market at a discount to pass on for high yield returns to our investors. So mortgage notes are a great investment. And the reason why mortgage notes are a great investment are because there are only 3 possible outcomes with a mortgage note. One being they are paid in accordance to the promissory note, right? Paid as agreed. Second is they either get paid off, sometimes through refi, sometimes through selling of a home, sometimes because somebody hit lotto. Nevertheless, the note gets paid off. The third outcome is that it's failed to pay. Failed to pay means that there are no payments. The note has gone into default. there aren't any terms that seem to be able to work out with the borrower, and so the property has to be liquidated. It goes into foreclosure, you could do cash for keys, but nevertheless, these are the three outcomes of a mortgage note: pay, pay off, or fail to pay. But with that, knowing that these are your options and the only exit strategies for mortgage notes, this puts your investment and you in a control seat to manage your investment and not losing on your investment. So let's talk about vetting the asset, vetting the mortgage note, considering a note to buy. One of the most important things, of course, is what is the status of the note? Is it a performing note? Is it a non-performing note? Is it a reperforming note? A reperforming note is equivalent to a fix and flip, meaning that the note was a non-performing note and it was able to become a performing note either through a loan modification, new terms, etc., and the borrower followed through on that. And then in the season time frame, it's now considered a performing note and can be resold as a performing note. So there's the investment. You bought it at a discount because it was a non-performing note, and then you rehabbed it, just like you would do a house. You rehab it and you forced equity. You rehabbed the note and modified it, and now it's performing, and now it's a premium note that can be sold in the market at a higher price than what was bought. So then there's another way you can get greater returns on your investment. The other status you want to know is whether or not it's in first position lien or a second position lien. These two liens are collateralized by the deed, and so even if you choose to invest in a second position lien, it's still asset backed by the property itself. The other considerations, just like there is no house, no fix and flip that's the same, there is no note that is the same. And the note considerations is really unique to the investor. So things that become important to the investor that should be considered is the location, for example. What states are you familiar or want to invest in or comfortable investing in, right? What is the neighborhood like? What is the crime like? Because one thing that you want to take into consideration, worst case scenario is that you may end up with the property. And if you end up with the property, or if you want to resell that note to someone else, right? The factors that are involved in that note are associated with the property, and you want to make sure that this is a property that someone else or yourself would be able to optimize on the property. Would you be able to sell the note? Would you be able to sell the property? So you want to look at all those factors just as if it was a real estate property in itself. What type of property? Is it a single family property? Is it a multifamily? Is it commercial? You want to look at payment history. What is the payment history? I know a lot of people think about credit, but sometimes credit is not as important as payment history because there's so many algorithms that go into credit. But, people may not pay their credit card, but they pay their mortgage. People tend to do whatever they can to stay in their house, especially if there's equity. We had a big influx of equity into homes over the last year or two. People don't walk away from $100,000 of equity in their house. And so you want to look at that. You want to look at those factors that are involved and what is the payment history, what is the habit of the borrower. And those are factors that are real when it comes to considering the asset to purchase. The other thing that you want to think about is judicial and non-judicial states. Some states, you need to understand their foreclosure laws. What does it take to foreclose the property? Because if you're faced with foreclosing the property because of non-payment, what are you looking at? Some states may take as long as 18 months. Is that okay with you? It may be okay. You may like the area that's 18 months. It's all right. You'll wait on it because you know that you got a great buy on that house, right? On that mortgage. You know you can do great things with it. Or that is a factor for you for your portfolio. And so you don't want to impact your portfolio by waiting 18 months because there are states that will foreclose inside of 60, 90 days. And so these are factors that are involved when you're vetting the asset. And you want to make sure that when as you continue to buy in mortgage notes, as you continue to buy in certain states, you will become very familiar with the process, what it takes, what do you need to do, and how quickly it will move through the system. So when you're vetting the asset, this is just a handful of some of the things that you look into, but these are definitely the most top things that you should be considering when buying a mortgage note. So how can you invest in mortgage notes with First Shield Financial? We have 3 opportunities that the company offers for you to invest in mortgage notes with First Shield Financial. The first one is an independent investor, but it requires a membership, the membership fee that goes along with joining the community, and we'll talk more about that. The other opportunity is a joint venture, meaning that you will partner with First Shield Financial, and that too requires the membership. And again, on the next slide, we'll see more of it. And then the third one is private money lending. Basically, as a private money lender, there's a loan hypothecation with First Shield Financial, and in return for your capital, there is a interest rate per contract where you get a return on your investment, and we'll discuss more about that. Okay, so as per the previous slide, we had 2 opportunities that required to be a member of First Shield Financial community in order to partake with investing in notes, either as an independent investor or joint venturing. Just to talk about a little bit about the joint venturing option is that you basically partner with First Shield Financial, and as a partnership, you're both responsible for the note investment. You're both liable. You have liabilities with the note investing, and you also will profit from the note investing. The independent investor is not looking to joint venture, but will become part of the community and can partake with reviewing of notes. So the membership itself is a one-time flat fee of $999. And that right now is our fee for 2023. There will be some changes in 2024, but they haven't been solidified, so this is a good time to get in. I don't know what the changes would entail at this point. It's just that we've had a lot of interest and we need to make a bigger investment into the community as well as the company. And so as that evolves, of course, I'll share that with you. But right now, the membership is a one-time fee, not annual, but one-time fee to join the community of $999. You will join the community. You will have access to notes that the company gets. We have a weekly Q&A call, and then there's coaching. So just to expound a little bit about that, the community is an opportunity to always have someone you can call, you can email, you can say, listen, let me bounce these ideas off of you. What do you think, right? As far as access to notes, the company gets tapes, as we call them, from different resources that provide us tapes. These tapes come in, I guess, regularly every 4 to 6 weeks. I say that because the fourth quarter, it seems like they've been coming every 4 to 10 days. But, you know, it's the end of the year. Everybody's trying to get, you know, mortgages off their books. So, but we don't charge every month for a tape or when the tapes come in. If you want to have access to the tapes, then it's a $25 charge. But you must be a member to get access to the tapes. So the reason that being is so that if you're not everybody's ready to buy or may not buy every time a tape has been issued. So it's a matter of when you want to have access to the tapes. You're charged $25 for the tape. The Q&As is an opportunity to bring any questions you may have, real life circumstances or situations, maybe need a little bit of guidance going one way or the other. You know, this also evolves into coaching, especially if you're JVing. This is all part of the membership that comes with your one-time fee. This slide depicts the relationship between First Shield Financial and the PML investor. It is not required as a PML to be a member of First Shield Financial. You certainly are welcome to also be a member of First Shield Financial, but as a PML, we basically do everything for you. So the investor advantage is that you will receive steady monthly income, passive income, per the term of your contract. Meaning that, and we'll show this on the next slide, but whatever your capital was that you invested and the interest rate per that capital, that's what you'll receive every month in your quote-unquote mailbox or passive income. Behind the scenes, First Shield Financial does everything else. All of the logistics, as far as vetting the note, aligning you or the PML with a property per the terms of the contract. You know, there are investors that only want first lien positions, or there are investors who don't mind or want to see a steeper discount with second liens. There's opportunities depending on, you know, what the PML wants to do. So all of that is taken into consideration, and those considerations are handled by First Shield Financial. And based on those considerations, the expectation is then passed on in the form of return on investment to the PML. So it's basically a done-for-you kind of relationship in the form of a hypothecation. Okay, this is a sample model for the PML investor. And we're going to just use very simple numbers just to convey the relationship and how this would work. But so if the PML invests $100,000 and the annual rate of return is 8%, and understand this is just being used for the model, 8% is a good number, you know, that's about right. But, you know, there are dynamics and different things that may change that number. But let's just work with the 8%. And let's look at the term of the contract. It could be for 12 months, 24 months, 36 months, 30 years, if you like. But for each year, you get $8,000 on your investment. And so dividing that by 12 months, the monthly return on investment is $667 rounding off. That would be what the passive income would be for a PML. And in this, there is no other involvement with the PML. There certainly is transparency, reporting, etc. But all of the management, logistics, and everything that's involved with the investment is handled by First Shield Financial. At the end of the term, let's say you invested for 12 months. At the end of 12 months, when the term matures, the investor gets 100% back of their investment. There is no fee, or there isn't even any pre-penalty fee for if there was some kind of emergency, for example, and the PML needed to withdraw for some reason or another. We do what we can to be able to work everything out in regards for the PML. So in closing, just want to point out a few things in regards on how we can leverage some of our already existing tax accounts that or other accounts that we may have that we could use to invest in notes. High yield savings accounts is an opportunity to be able to use those funds to invest in notes because the return is much greater than what a high yield savings account will be able to offer. The maturity of a CD, when that matures, you can definitely take that money and invest it in notes, roll everything over again. 401k plans. While there are some restrictions in different 401k plans, especially if you have one by an employer, if you're still employed, but there is typically opportunity that you can invest from a 401k plan to invest in real estate, and mortgage notes would fall in that category. And so, you have to look into what that would do. But definitely returns are more stable, some cases higher. You're not faced with the kind of fees or the volatility of the market because it doesn't impact this investment. As we spoke about earlier, your investment is backed by the property itself. And so the things of the economy, the things of the market, the things of change in administration, those things do not change the stability of your investment in a mortgage note. And that's key. So you can even bring stability to your 401k plan by using that money to invest in mortgage notes and having that return on investment to come back into your 401k plan. Self-directed IRAs. This is a perfect match for self-directed IRAs, to be able to use your self-directed IRA funds to purchase mortgage notes. And then the return goes back into your IRA. Whole life insurance policies with those cash options. Perfect to be able to use the funds there to be able to reinvest and then get the returns back. Health savings accounts. Believe it or not, you can use that to purchase mortgage notes. Like me, out of pocket, I used, as well as when I was fixing and flipping, when I refied or sold, I took the proceeds and I started investing in mortgage notes. There is a mortgage note out there for everyone. It is not impossible to buy a mortgage note. Not all notes are $100,000 and above. And so it's something to look into. When I first started, I had bought one, then two, and because I was joint venturing, I'm now up to 49 notes. And so just a little over a year, 18 months or so, this is a much better investment regimen for me. And I think that it definitely has strengthened my own portfolio, and those whom have joined forces with First Shield Financial have also said the same thing. So it is something to explore, get to know better, and make your own decisions what will work best for you. On the next slide, I will provide how you can best contact me and if you would like to follow up. Note, invest with us. Okay, so here's my contact information. My email is kim@oneshieldfinancial.com. You're welcome to text me on my cell phone, or you can call. If you're interested, let's talk. Let's explore a little bit, see if this is a good fit for you. Thank you for your time. Take care.